We are back with Coffee with the John, Season 3, Episode 1, and it's a special one. We are bringing on, we have brought on a special guest. And like I said before, we're going to be doing this more and more, bringing on different people, get different points of view, so you're not always listening to our one point of view. And in this
It's
case,
the right one, though.
it's always the right one, but you know, hey, people could be wrong sometimes. By people, I mean them, not us. That being said, it's a great pleasure to introduce a good friend of ours, a local investor. Used to be a local investor. He moved out
That
of
was an
state.
out-of-state investor.
And Mr. Andrew Middlestat, welcome to the show.
Good morning, gentlemen. It's a pleasure to be here with you.
It's great having you on. So Andrew Middlestat has been working with us for how long now? A couple of years now.
2017, I bought our first deal from you guys as a wholesale.
Oh, that's right.
Yep.
Wow.
That's when you got that first random call. I remember it, too. I was driving through a neighborhood, and the windows down, doing some driving for dollars, and just get this random call. I was like, yeah, I'm just kind of calling around different websites and stuff, and I saw you guys were wholesalers, so I'm just trying to see what's up.
Well, I remember I was following John Barbera on Bigger Pockets, and I called the number, and John Barr answered. I'm like, well, I want to talk to John Barbera. He's like, well, you can talk to me, too. I'm like, no, I want to talk to John Barbera.
I don't know who you
I'm
are.
special,
Screw
too.
this guy.
So,
But yeah, so in this whole time, one of the things that I've always admired about you is I always hear so many people say, you know, you got to quit your job in order to be in real estate. You got to go all in on real estate. And you are a full-time pilot. And so is your wife.
Correct.
And you guys have been killing it in real estate. You know, you've been doing very well. And I use you guys as a huge example. It's like, especially when I meet people and I hear this all the time. Yay, I'm quitting my W-2. And everybody's like, oh my God, congratulations. And I'm like, why? Why would you do what's your goal in real estate? Well, I figured, you know, at first I'll probably, you know, wholesale a few properties, try to get some cash and maybe flip a few so then I can eventually buy some rentals. Like, you can cut that whole curve if you just keep your W-2. So with you, what was it that made you not quit your job to go full-time for real estate?
certainly, I most wholeheartedly agree. It's for a couple of reasons. First of all, I guess I'm one of the few that actually enjoys my W-2 job. I like going to work and flying airplanes. But second of all, and probably more importantly, having that W-2 income is such a huge asset. It makes purchasing and refinancing property so easy. And when you go to a lender and you can, you know, put a good W-2 slip in front of them from the year prior, they're happy to do business with you and give you good rates. And it just makes the whole enterprise so much easier to be able to do it that way. So, and one thing that I think people forget is we live in such a black and white world that people say, I need to be a full-time investor or I need to be a full-time W-2 employee. Like you can meet in the middle and have a holistic approach where one kind of blends into the other. You know, it's like when I'm flying airplanes, I'm out flying airplanes, but when I'm investing in real estate, I'm investing in real estate. And they're one and the same. They kind of they bend and they flow nicely, and they they both prop each other up.
And can you give like just a brief summary of your real estate experience since you bought your first property? What have you done in real estate since then?
Yeah, so we bought our first rental property back in 2013. It was a single family house down in Rainbow Hills in Southwest San Antonio. Since then, we've purchased and had ownership interest in somewhere around 30 to 35 properties. We've had single family rentals, both long-term and short-term more recently. We've done residential assisted living facilities, invest in apartment syndications, land deals, both commercial and residential. And also now we're getting into some new build stuff for short-term rentals. So it's
So everything.
it's been quite a bit, but we do, because we don't rely on the income per se.
Right.
We do what we enjoy. Like we wouldn't be investing in real estate if we didn't enjoy doing it. So we just kind of follow the path of what we enjoy doing, what produces financially, what produces in terms of rewards on, you know, pride and challenge, and we can really follow that because we have the backstop of a W-2 job.
And do you think an advantage to having a good W-2 job and enjoying real estate for what it is allows you to take the time to really dig deep into what you're about to invest in, be more cautious, be more educated versus somebody that quit their job. They're having to wholesale, they're having to do all this where you don't really, most wholesalers don't take a lot of time to learn different strategies because they got to pay the bills. They got to survive. Where your bills are taken care of, do you spend more time educating yourself about these opportunities?
Yeah, of course. It's much less stressful.
Yeah.
It makes it more fun when you have the time and the knowledge and the ability to jump into these things without having to, like, you're not forced to produce to put bread on the family's table.
Well, I think one of the biggest things for your guys' selves as well, and we would tell people this all the time, it's like, oh, but I have to go all in real estate because I need to make the income. There's higher income there, then I can put it back into real estate. It's like, well, no, you can have a W-2, live below your means, and actually save money. And so you can have that down payment to buy your first rental property, buy 2, buy 3. Everyone just like, they're just so impatient. To where it's like real estate is a very slow game at first, but then it can really build on itself and like that compounding interest kind of thing. It's like once you get 1, 2, 3, 4, it takes a while for that stuff to go.
Mhm.
Once you get 4, 5, 6, 7, 8, 9, 10 of them, it's like now this cash is really starting to come in. You can really start doing a lot of things, start refinancing some cash out to where like they're just too impatient.
Well, we
Um,
started what 2 years ago maybe with like 1 rental, 2 rentals, and now we're up to 14.
As of yesterday, yes.
Yeah. So I mean, it's something that like the first year or two, like we didn't have that many. What do we have? Like 3 or 4? If
One,
that.
and then like
Yeah.
that was like probably 6 months, and then those like we got pretty lucky because we found several sellers that had multiple properties that wanted to sell them all. So that
Mhm.
was a benefit. I mean, I think 7 of them came via that route of properties like that. So that was a benefit that really kind of pushed it up. But yeah, it's just one of those things that it just takes a minute to get started.
Yeah, I guess that's the power of velocity investing as well. Is, we bought our first one in 2013, and we didn't buy our second one until, well, from you guys in 2017.
Wow.
And then 2 turned into 4, turned into 10, turned into multiple dozens pretty quickly.
Yeah, for sure.
So what questions did you have?
Well, I mean, I guess so. What drove you into getting into real estate? Like, what in 2013? Like, what was it like for Andrew and your wife to be like, you know what, we're gonna go into real estate? Like, what took you there? Because I know what took me there. It's just like I was always in construction, always in housing and stuff like that. And it's like, hey, money can be made. I found bigger pockets, found rich dad, poor dad, and then it's like, here we are 8 years later. But what was it for you? How'd you guys get into it?
Yeah, so I guess at the time we were, well, real estate's very expensive to get an education in. So at the time, at the very beginning of our careers, it was motivated financially to be able to get in, pick up some houses, either rent them or flip them, and be able to pay off our student loans. And that's why there was that big gap from 2013 to 2017, because we went in it financially motivated and knew that we wanted a challenge outside of flying airplanes. We knew that in the future we'd have decent amount of time off to be able to do it. And that was the only house that we had ever lost money on because we went into it with the wrong intention.
I was just
So
going to
we-
ask, did you win money? Did you make money
So
or lose money?
we
on that?
lost about $500 when it was all said and done. So it wasn't financially devastating by any stretch, but it allowed us to sit
Emotionally?
back and regroup. Emotionally, it was frustrating. Like it was.
I was like,
I've-
emotionally, that's when that one hurts.
I've lost sleep exactly 2 nights over real estate investing, and they were both over that house back then. So we sold it, regrouped, and just redefined why do we want to do this. And it was obviously financially motivated, but it was for the challenge. It was for the social aspect.
What was it that made it go bad?
We just did everything wrong. I got an inspection report, and it turns out that the roof was put on completely incorrectly, and I didn't read it properly. So when we went to go sell it, the buyer wanted like a huge discount because he had to put a new roof on it. We didn't put in a good heating system, and that winter we had some nights that were like 21, 22 degrees or something similar. And our
Nice.
tenants called just freaking out, and we had to drop a bunch of money to try to keep them warm, which was the right thing to, it was
Yeah.
right for them to ask, and it was wrong for us to remodel incorrectly. So, yeah, I guess to answer your question, it's just, it's challenging, it's thought provoking, it's mentally stimulating, and it's also, financially incentivized so that you can go out in the world and do some good and help your family and help others.
All right. So fast forwarding, just wanted to get to pretty much what we talk about on the show is the current state of the economy, the news, trending, what's happening, all the policies that are being brought in. And one of the biggest things that affected this economy was the pandemic and the bailouts. So you are in the airline industry, one of the industries that were bailed out, by far the most. They were very scared of the airline industry crashing. How was that experience for you when that first happened?
As an industry, it was terrifying.
Mm.
We thought we had the largest displacement. The airline that I work for is one of the largest in the world. We had the largest displacement in the airline's nearly 100-year history. We were expecting up to a third of the pilot ranks to be on the streets furloughed, along with tens of thousands of flight
That's how it
attendants
happened
and
previously, right? Like in the past, like '08, 2000, like they just cut people, and
they just start
that
cutting
was the
costs.
thing. It's like in like your industry, it's like you can use it anywhere else. Like you fly massive jets, planes through the air. Like
Yeah.
where if they're all not hiring, where do you transfer that skill set?
Yeah. So
Home Depot.
Well, that's what I said. A lot of guys
Well-
like they'd be car sales, use car salesmen, but an airline pilot when they got laid off. It's like
sometimes you just do what you have to do when you have to put food on the family for your table. Fortunately, a lot of our coworkers are in the military, so they could go back to either reserves or active duty. But there are quite a few people that are purely civilians that needed something else to do. And this is partially why we got into real estate investing, as well as, it is a risk mitigation technique for a highly cyclical industry, is part
Yeah.
of the reason we got into it as well. So it was from an industry, it was very scary. The airlines were, in 2019, we were making billions of dollars and getting profit sharing checks. And then all of a sudden, 6 short months later, we're all going to be on the streets and the airlines are losing billions of dollars. And it was terrifying. For us personally, we saw it as an opportunity to maybe focus on the real estate investing more. And turns out that we certainly learned some new skills, got into the short-term rental game, and picked up some more long-term rentals with you guys, and could really focus on that stuff. But overall, I guess when the pandemic first hit, it was very unnerving.
And,
I can imagine, especially just saying like, and another thing that I always kind of talk about, and I feel like we've done successfully is like, for some people, they all want to go all in on one strategy of real estate. Like, I'm only doing short-term rentals. Well, if the pandemic had gone the other way, when you first got into it, you're just like, nobody's traveling, nobody's going to Airbnbs, nobody wants to have that, like, oh, somebody was just in here last night that I could possibly get sick from. And like, if this was a serious thing, like, you're kind of really screwed if you're all short-term rental. And that's where it's like building a foundation of like, hey, you got traditional single-family residential houses that are like kind of like the backbone of a portfolio, and then you can kind of move into the other things. I mean, what are your kind of thoughts on that? Because you've done short-term rentals, you've done assisted living, you know people that have done like the rent by the room thing. I mean, what do you really kind of think, and John, for yourself, as how does that play if like this would have gone the other direction, like having a good portfolio of properties first before just trying to jump into things that boost cash flow, but kind of at a riskier play?
Yeah, like you alluded to, the long-term rentals are, I almost look at them as like the bond of any portfolio, right? Like they should be stable. Even during 2008, rents rose shallowly in San Antonio. So obviously a global pandemic is not something anybody saw coming. We didn't know how to mitigate against that. But if you have good risk mitigation techniques in action, that's all that you can do. And it turned out that it worked. Worked out well for all of our houses. I know some people had issues with tenants not paying, but it seems like to have a good backbone of monthly income from long-term rentals was a huge benefit. But then also, it seems like if one part of the industry gets hit, maybe one doesn't get hit quite as much. So having different exposure to different levels of real estate in apartments, in land, in long-term rentals, short-term rentals, if you have your hand in a little bit of everything, the thought is at least that one of those will be successful and will get you through.
well, I mean, diversification is always huge. We always talk about it, and especially within real estate, you should diversify. I mean, even just if you were to just do a buy and hold portfolio, no short-term rentals, nothing like that, I still think that you should diversify within that. You should have a balanced portfolio of properties that have a constant appreciation as well as decent cash flow. Then you should have another one that's probably a lot more appreciation, not so much cash flow, and another one that's a lot more cash flow, not so much appreciation, right? So then you kind of start hedging your own investment portfolio with, cash flow appreciation. So whichever way the market goes, you're kind of protected in either direction. One thing that I've been thinking about lately a lot is in this market, there's a lot of people that look like geniuses, right? Because the market is making people look very, very smart. Oh, I'm flipping all of these houses. I'm wholesaling 35 houses a year, 50 houses a year. I'm doing this. I'm looking at my Airbnbs. And it's like the market is making you look very, very smart, but your fundamentals and your foundation is non-existing. And that's one of the things when I started in real estate, I started learning from Rich Dad Poor Dad, right? And Robert Kiyosaki is just so big on cash flow, so big on, passive, being a business owner and an investor, not an employee or self-employed. And like, he's so big on these things that I read all his books and it kind of like ingrained in me. And I study a lot of history, especially economic history. And when I look at all those things, that's why we've been so hesitant to get into Airbnbs. Because when we look at them, we're like, Airbnbs are still, especially at the time, they're very speculative, and there are people buying more than what the house was worth, including repairs. It wouldn't have rented to cover their mortgage, but they're like, yeah, but I'll kill it with Airbnb. And I'm like, and if you don't? They didn't have an answer. They didn't know what the fuck else they were going to do. They had no reserves. They had no backups. They had nothing. And I was like, that's the problem that I see. Is like you get into this speculative investing, all these things. And right now, because of the market, everybody looks like a genius.
Well, that's what I was saying. Like the fact that it's like that's their only one and only strategy.
Yeah.
And like these things do not convert to long-term rental properties, even cover the debt services they've got. It's like, but if you don't have that good portfolio of cash flow to support those months, like, hey, can you go 3 months without getting income off that one property? And we just had a rental property turned over and we had to do some renovations to it. Yeah, our cash flow dropped by that amount of rent, but it's like we still had positive cash flow across the entire portfolio. So that definitely helps. We're like, yeah, those short-term rentals, especially you get like these areas where you see a lot of that stuff's really kind of shaken out now with all the permits that have kind of gone by a lot of cities and stuff like that. But yeah, when they were like just buying everything and also like, oh, you now have to have this permit to be able to run and operate a short-term rental property. Everyone's just like, whoa, what the hell? Like you got 7 of them on this street. And they're like, well, you can only have one. Like, what are you going to do at that point? So you got to sell the property. And what we kind of saw is like if all those properties hit the market at one time, it could drive prices down. And you could really have an issue.
What I think also, what I think is crazy too and dangerous from people right now is that when I say these points to some Airbnb investors and stuff like that, they're like, yeah, but who could have seen this coming? I'm like, exactly. That is the point why you set up a strong foundation, because you just don't know what the future brings. Nobody supposedly could have seen this happen. Right? Nobody knew that it was, and even nobody knew it was going to happen the way it did. When the pandemic first hit, we had just bought a house that was like tight margins of profit, and everything shuts down literally like the day we close. The day after we closed,
like everything. Like
I remember calling him. I'm like, "Did we close on it yet?" He was like, "Yeah." I'm like, "Oh shit!"
Because like, yeah, just signed the documents. Yeah, a little bit
like
ago.
It's like complete shutdown. Nobody leaves their homes. We're like, is the real estate market going to tank? What the hell's going to happen? We never expected that it was going to skyrocket because people were going to flee from like apartments, go into bigger homes and do all this. Like, we didn't know that. And it's just one of those things that's like, that's the point.
So, and also going back, I guess kind of a contrarian view to what you guys are talking about is we live in a cash is trash type world right now.
Mm-hmm.
I always like sitting on at least 6 months of reserves, if not more, in case something were to happen. Like, I'll rest my head easy at night knowing that nothing is going to happen to the nest egg. And so we've been comfortable in a W-2 job, my wife and I, for a decade now. And when we've always built the real estate portfolio as a hedge to an airline downturn. And when we not knowing that we would completely lose our jobs, so relying upon the long term, going from good W-2 to no W-2 to relying on the long term rentals, it wasn't enough. We realized that we actually had a lot of equity in properties, but they weren't producing a lot of cash flow. So on the flip side to what you're saying, we realized, wow, we really need to get some cash flow built up quickly. Like we were doing it as a long-term wealth generation technique, not so much to live off the money.
Okay, that's also the problem. Like the time you need that equity, you lose your job. Ain't nobody giving you I get you got cash flow and stuff like that, and a bunch of equity, but we don't care.
So although I do agree with what you were saying, from the flip side, like a real world case study, we needed to go from good income to no income to all of a sudden generating larger amounts of cash flow off these properties, which is kind of what forced us into the short-term rental game. It was kind of by accident.
Yeah.
We were going to go travel for a while, and we rented out our house in Colorado on Airbnb, and it rented well, and we turned our only liability into an asset, and that asset was producing good cash flow, which really showed us how powerful the
It's kinda
short-term
like
rental
that was
game
by
can be.
accident, too.
It was
Well,
by
let's just rent
accident.
it and see what happens.
But at the same point in time, we didn't overpay for the house specifically for short-term rental income either.
Yeah.
So there needs to be a little bit of hedge against the overpaying.
So it was one of these,
Well,
you used,
what
you
you were
used
saying.
Airbnb like it's supposed to be used. I bought a homestead and then I rented it out for short-term periods.
Well, and going back to what I was saying is having a diversified portfolio. It's like you should have. I think your base should be of properties that have potential for appreciation and good cash flow, and then go to purely cash flow properties and go to purely appreciation properties to really hedge yourself. Like if one takes a hit, your cash flow is going to be taken care of. It's
Yeah.
going to be good. It's in a good secure area. You know that cash flow is always going to be coming in. Yes, you can't sell these, but you're not struggling. You're not hurting for it.
Well, that's just saying, like, if for our sake and stuff like that. So we have a lot of short-term, or not short-term rentals, but like traditional rental properties boosted by cash flow from short-term rentals. But if something were to happen to that short-term rental, we needed to rent it out, it probably wouldn't rent it for what the debt service is going to be, but it will be at a negative $100, $200. But from the positive cash flow of everything else, it
Right.
can sustain that. So you're not like, I need to liquidate everything like you see a lot of people to do. I mean, at that point, yeah, I'd look at it as you're playing kind of like the stock market. You're so over leveraged, and then you have to sell everything, all your winners, to cover your losses. Or like, well, if you built a property where it's like, hey, your foundation sustains the more speculative, higher generating
Right.
cash flow, higher risk stuff, to where if it goes wrong, you can turn it into something else, and then you have positive cash flow while you wait a year or two for certain areas to come back.
So here's something else that I've been seeing with speculation is I've been seeing a lot of investors or potential real estate investors, wannabe real estate investors, all of a sudden go head first for cryptocurrency and Bitcoin and all these things, right? And going back to your point, you say, I want to have at least 6 months of reserves. I want to do like that's how I look at it too. To me, I'm like, if you got to set your foundation first before you start speculating on all this, because everybody wants to get rich on crypto and Bitcoin and all this. And I'm like, but you have no foundation. Your business is not even set up and running effectively. Like if you don't keep marketing, you're out of business. If you don't keep wholesaling yourself, you're out of business. Like you have no business. You understand? Like you could be out of business in 2 seconds, and you're diverting your attention and capital to something completely different from what you're doing. Where I'm like, why aren't people like focus until you have a foundation? Once you have a foundation, then you can speculate, right? I mean, what is your thought with kind of just jumping too quickly into other things?
No, I totally agree with that, because once you have that foundation you're speaking of, once you have cash flow and you have equity and you have good income potentially coming in from a different job or wherever that may be, that's when you can afford to take those riskier bets, whatever risky is to you.
Right.
Once you can afford to lose the money, and although it will be upsetting, it's not going to affect your lifestyle at all. That's when you can afford, and that's only when you can afford to take those
Well, I
riskier
think
bets.
the American society kind of really pushes people to like get out on. I mean, we're a consumer society or a consumer nation, and it's like stretch for this thing. You can see and I think social media doesn't help with that at all. You see everyone else living these lifestyles, like, well, I want that, but I need to make a bunch of money to do it, and this slow W-2 thing just takes too long. So I'm gonna jump into wholesaling. I'm gonna jump into flipping. I'm gonna jump into crypto. I'm gonna jump into whatever it may be at the time. Back in like the 1600s, the tulips, to try to get rich too. I mean, society's done it like always. That I think that's like the downfall of like our race, is that the greed that can really, and not having the discipline to look at it from a long-term perspective. Like, hey, 6 months first, and then I will move into something else.
Well, and I mean, I don't know if you meant to say downfall of the race, but I think it's more of like
Detriment, not downfall, but
but
just
it's
like
a downfall of people,
what's-
individuals. I think
flaw. There we go. The
yeah.
flaw of our race to a lot of like modern society is like the greed and want to be. I want that, and I'm willing to take huge amounts of risk and get blinded by the greed and the want for it, and not be like, let me go think about this for a second, look at a second opinion. Is this the right way to do it? Is it safe to do? Is it smart to do? But people just jump at it and go.
And I'm more looking at it kind of like on a brain power perspective, right? If you are, let's say you're in your business, you're starting off as a flipper or wholesaler or anything like that, and you don't even have systems in place, you don't have employees, you don't have automation, you are the linchpin to your business. Like anything happens to you, your business goes under. You should be spending any amount of time you have, mental capacity, on thinking about how to fortify your business, how to grow your business, how to expand your business, how to make your business strong and that foundation strong. If you are trying to jump into, you say, hey, I'm going to wholesale single family homes, but I'm also going to do multifamily, but I'm also going to do an Airbnb. The amount of time you got to spend trying to get educated a little bit on multifamily, a little bit on Airbnb, a little bit on this other thing. It's like you know a little bit about a lot, but you don't know shit about anything specifically. Like you
Jack of all
can't,
trades, master of none, kind of.
yeah, and you can't narrow down and really focus and build something out because you're spread too thin. And even just thinking capacity, it's like you don't even have the brain power to dedicate the amount of thought that you're going to need to get creative solutions, right? You could think about like strategic systems and things that you can implement, and you're wasting all this energy and potential on like, oh, somebody's doing Airbnbs and they're killing it and I want to do that too. And I'm like, you don't have a business. Like, what are you doing?
Chasing the shiny object can be fun. It's fun thinking about the possibilities they can provide, but
Especially when you do get those like short-term wins. It's like if you put something in crypto at like 20,000, then you see it shoot up to 60, you're just like, I'm a big believer now, instantly.
So
It's just kind of like seeing those big wins and
yeah,
stuff like that.
but
It's like,
I'm a big believer, but you still don't understand.
oh, yeah.
That's the whole point is like everybody's jumping into, let's say, crypto, and they're like, oh, it's an inflation hedge. It's an inflation hedge. You're going to see. And I'm like, it's not moving like one because it's volatile as all hell. You understand? So it's like you look at it, it's like right now it's a very speculative investment. Could it be an inflation hedge? Could it be a better kind of, asset to put your money into just to diversify a little bit from cash? It could be, but it isn't right now. Right now it's purely speculation. It's been people that have been getting easy money dumping it into Bitcoin just because everybody keeps saying it's going to go to 100 grand. It's going to go to 1 million. And I'm like, that's not why you buy it though. You buy it because it's going to supposedly be an inflation hedge, not because it could potentially go up to the moon. You're buying it for the wrong reasons, I believe, right? But it goes back to like the effort that you're putting behind it. It's like now all that time you're wasting on that. And what are you doing with your business? Why are you struggling in your business? Right? Us right now, like the 14th rental that we picked up, we're turning it into an Airbnb. The only reason we're doing that is because we're partnering with you and you have experience already doing Airbnbs, right? Because if it wasn't for that, we wouldn't be doing it because to us, it's like, that's a whole other monster. That's a whole other process, systems, way of thinking. We got to make sure that our business can handle, supplement that as well as everything else that we're doing in our business. And that's not our goal to sustain our business at the moment. So we couldn't go all in on Airbnb at this moment. Like we wouldn't do it. It wouldn't be smart for our business. But now we partner with somebody that does understand it, that can handle it, that knows, like you're cutting our learning curve tremendously by doing that partnership. Does that make sense? I mean, like, instead of jumping around, kind of being a little bit, more cautious.
yeah, it does. And we've done a lot of different types of investing over the years, but we've tried to just do one or two at a time and become good at them in order to provide the best product and to cut down the learning curve and to learn these proper systems and
Well, that's the same.
processes.
Like, and you've done that too. Like with you guys used to have some assisted living facilities, and I remember you tried to like, I'm worried you're going to do the business model of being an assisted living facility, and you found like the regulatory burdens. You're like, never mind. But then you guys like sold that off because it was like it was okay, but it just still had its flaws that just like didn't work for what you guys wanted. So like speak on that a little bit of like the assisted living facility like model, because a lot of people do hear, because that's another hot topic when everyone comes around, when the guru starts coming around preaching assisted living facilities, and then everyone's like, I'm gonna do these assisted living facilities, and it's kind of like the short-term rental, it's kind of like the owner finance, like everyone gets hot for it. So what was your experience doing assisted living facilities?
Yeah, that was the reason we had gotten into that is because we met some partners that were doing it and wanted to expand their business, and they needed a real estate investor just to be a homeowner that they could rent from and therefore operate their business out of. And it's a great model. I think the residential assisted living, there's typically 4 residents and 1 caretaker per house. And I think during the silver tsunami that we are starting to see in a southern state that we are living in, that the population of the elderly is increasing dramatically, it's a great niche. I think that there was a couple of difficulties that we had seen that I would suspect other investors would say the same, that the labor for these is incredibly difficult right now. Finding good quality labor that will
I don't think it's
work.
just for these. I think that's just the economy right now.
Of course,
Good quality labor
yeah.
for anything.
Yeah.
It's in general. A lot of times in the types of houses that you want to do these in tend to be in HOAs, and HOAs don't like them. So we had to find stuff that were outside of restrictive homeowners associations to do it. And although it's a great product, it wasn't right for us. And like John and is talking about, it's to get in, to learn something well, to try it, and to find out it's not for you. There's nothing wrong with that. That's just learning and progressing. Right. And then, okay, like we've enjoyed it. We've really enjoyed the people that we were working with. We enjoyed the people that we were helping. I like stopping by and saying hi. But COVID changed a lot for us. And the reason we sold those is because we thought we were losing our jobs. Mm-hmm. And we just wanted a better cash cushion to, if we were to be on the streets, I guess, if we were to get furloughed. And so, but that allowed us to get into the short-term rental game and to focus on it and try to get some systems set up and really learn how to operate it to a high degree. So like getting into something and trying and working, finding out that it's not for you, there's nothing wrong with that.
Would you invest in that kind of product again?
Yeah, certainly.
So it was a good experience, just like at the time for certain things. It's just like, hey, we're going to move away from this and go to something else.
Yeah, exactly.
Well, and it's also kind of like, when somebody gets into real estate and the first thing, they know nothing about real estate, but all of a sudden they want to flip a house because they got some money. They go in, they lose their ass, and then all of a sudden they're like, real estate sucks. Like, no, you sucked. Like, real estate is still great, right? Assisted living facilities is still a great investment, it's still a great strategy. It's just, it wasn't executed correctly at the time, or maybe you didn't have the right partners, or maybe just the situation wasn't right. But it doesn't make it a bad strategy. It's just something that's like, all right, I've tried it, it didn't go well, we're gonna hold off, and maybe we'll try it down the road.
Yeah.
Right? It's not just like shutting down completely and saying, life sucks, real estate sucks, I'm leaving.
Certainly, it's as with most things in life, it's neither 0% or 100%. Sometimes the answer lies in the middle, and that's okay.
And if you guys are enjoying this talk, please hit that thumbs up and subscribe if you haven't. Help support it.
Punch it. Just nail it. Just click it.
Just smash that thumbs up button. And definitely ask your questions, guys. If you have any questions or concerns, I've been seeing a lot of great comments from Tommy, as always. So any questions or anything you want to put on, go ahead. Put it in there, and we're here to talk about it.
One thing, that I wanted to ask and stuff like that. I mean, kind of just moving along like with the news and stuff like that. Obviously, airlines were a huge piece of the quote bailouts back then and getting all the federal money to do this stuff. Like, what was the recovery like a year ago? Because I mean, you're talking beginning of 2021. It's like things were starting. The vaccines were starting to come out. Like, what was it like a year ago, and what is it like today? Because like we're in very different markets. I feel like, especially when it comes to travel with the whole COVID thing. I feel a lot of people are exhausted by it. Like, what are you experiencing like as an airline pilot from what it was a year ago to what it is today?
The reason the airlines got the bailouts was we were effectively told that we cannot fly. Governments were shutting down, not allowing flights to come in from overseas. Granted, there wasn't that same level of degree of shutdown in the States, but we were basically told that we can't fly to a lot of places and we can't carry passengers. And the reason we got the bailouts is because the governments were telling us this. And it was meant to float the airlines to get to a point where demand does come back. Nobody expected it to come back as quickly as it did. Business travel does seem to be coming back quickly, not as with the Omicron surge, is coming back a little slower than what we had thought. people traveling for pleasure has increased significantly. So a year ago, we were just starting to come back. There were maybe some inklings that demand might start coming back later in 2021. And at this point in time, we were still off. They were offering voluntary leaves, so we were taking them up on that. And then come about June time, May and June, demand just came surging back. So nobody expected it to be, what would that be? 15 months later, it goes from, carrying from several millions of people a day down to several 100,000 people a day, back up into the millions so quickly.
Yeah, and that's one of the
Nobody
things
expected it to rebound.
we always talked about. Like, a lot of people were pissed that the airlines were getting bailed out. Like, they were getting the money. It's like, why are the airlines not these other industries? And it's like, well, the airline industry is a very huge piece of the economy. Like, it's how a lot, like, I know the underside of, like, even passenger planes, like UPS puts it, there's packages are brought in there, like things are going, there's extra storage space. Like, a lot of stuff is moved around the economy via the air. So where, like, I think that was like kind of the plan. It's like, yes, airlines need the money. So when demand does come back, how fast, the pilots are there. They're ready to go. And that's what I think, like, it was a good move considering how fast things came back in 15 months. That is like, hey, we were able to get that leisure travel back up very quickly. And you had the pilots that could come back for that. So I think it was one of those that, like, we had that discussion when they were getting those bailouts. And I was like, I think that's their kind of their plan. And that's kind of how it worked out. But like you said, but business travel still isn't quite back. So, like, what is it like? Because you say the airlines, like, leisure travel is important, but that's not where they make their money.
Correct.
And it's like, it's business travel that makes the money. And that's the thing that still hasn't quite been back. I mean, you said the other day, you still haven't got that guy from New York to London last second by first class booking a $4,000 flight out of nowhere. Like, that stuff isn't coming back yet.
That's not there. And that's why you see the airlines. Some airlines are making a little bit of money right now. Some are still losing money, but we're still trending at a bit of a loss, but which reflects the lower fares that leisure travelers typically pay. So once the business demand does come back, they'll start making more money.
Are they trying to modify, like, business models or planes or anything like that to say, like, hey,
turning them into buses? You're standing holding on to a bar.
Well, just basically, like, just changing, like, marketing tactics, or just like how the business ran to say, like, hey, if business travel doesn't come back for 4 years, do they modify, like, maybe, okay, let's shorten up first class, retrofitting airplanes to add a few more leisure travel seats?
No, the airlines had to plan so far ahead of time that there was none of that going on. We'll just charge less for the seats that are already there. If we need less airplanes in the air, we'll put the ones on the ground that have been retrofitted for higher business.
I remember going to Kansas City and just, like, I don't remember when was that. It was, I don't know, but I just remember seeing, like, just Delta. I mean, it was like a graveyard of Delta jets just lined up on this empty runway. There's probably 50 of them just sitting there, not being used. Like you said, taking planes out of service. It's like, yeah, it was like almost just a graveyard of, like, these jets right on the side of the highway, right by the airport. It's like, look at all those freaking planes just sitting there.
And that was one of the things that, like, I've told you before. I don't agree with those bailouts, right? I don't agree that the airline should have gotten bailed out. Like, I get the repercussions of not doing it. I understand that. But we are getting to a point that I'm seeing now, and we've been talking about this for a while, is everything, like the airlines, has just become impossible to fail. If they fail, they tank literally everything. Everything goes to shit. So they can make as many bad decisions as they want with no repercussions at this point, because they know they cannot be allowed to fail. They cannot be allowed to not, to go out of business, because it's like, we've already put in too much. We already put in money in you when you were already weak. And what's going to happen? It's getting to a point where, like, it went from too big to fail to now it's impossible to fail. Like, what's that look like? You have that, what do they call it? Moral hazard, right? Where that's gone, right? You don't have to worry about so much about doing the right thing, because it's like, well, what are they going to do? Not bail us out?
Over the decades, the airlines have gone through a lot of consolidation over the last 20 and 30 years. So there's much, actually, airlines have been getting bailed out for decades. So this isn't a recent occurrence. This has been going on for many, many years. They haven't been as large, but we've also gotten to be to the point where airlines are starting to come up with different tactics when these things happen to keep people on the payroll instead of furloughing people, which potentially could take years to spin it down if it was going to be as large of a cut as I said during COVID, and then years to spin it back up to get everybody through training, to get everybody back into the aircraft and their seats that they're assigned to, and it costs a ton of money. So it actually saves the airlines quite a bit of money to keep people just where they're at and just come up with some other not incentives, but other different types of structures to pay people. Instead of furloughing us, we all, based upon our seniority, we took a reduction in hours. So we were working anywhere from a half to 3/4 the amount of hours that we were originally doing, but that kept people in their seats. And that's knowing that the pandemic was going to be more short term than after 2001 or 2008.
Yeah.
That was what they came up with. So I would say they've gotten better about this over the years, but there is, how do you overcome that moral hazard of knowing that you ultimately have the backstop of Uncle Sam?
Yeah, and I'm not saying that, the airline industries are evil. I'm not saying anything like that. I'm just saying from a business perspective, if there's really no way you can fail, what limits the level of risk that you're going to take? I mean, it's like a kid with a credit card and their daddy always takes care of the bill. It's like, when are you going to learn to control money? Like, that anytime I swipe that credit card, there's going to be money in there. I don't need to know where it comes from. So those are the things that, to me, it's like, I get it. Again, I understand why they did it and everything. I just still don't agree with those courses, because as we've gone through each crisis, everything gets worse. Everything
he's just stuck in the Stone Age.
Yeah, everything
when it comes to finance, he's 100 years.
Yeah, I'm still kind of more of like sound living, but
also once you started, you can't go back.
Yeah,
you're like the world, I think, would just absolutely fall apart. We would go backwards societally. Technology would go back. Business investment would go. Business would fail. Like, would something great come out of it? Sure, 10, 20 years down the road.
I completely disagree.
It's like I think if you
look how quickly businesses have adapted just in these last 2 years.
Well, but then look at the amount of money that's taken to do that.
Creativity, most of it. Like, most of these people came out of nothing. They weren't getting funded.
The Fed yes, the small businesses.
Yeah.
But where was that money coming from? It was coming from big businesses. It was coming from government bailouts, coming from stocks backs. The Fed coming in and liquefying the entire market with massive amounts of stimulus that let that trickle and flow through the economy. The stimulus checks, the mortgages that they stopped, the bailing out the commercial industry, saying with the commercial spaces where it's like, hey, don't pay rent, we'll do something because Uncle Sam's paying us money to sustain these commercial businesses. As like, if you wouldn't have done that, you would have locked the entire financial grid of everything, and money would have stopped moving.
I agree, but you're talking about stimulating the public versus funding a business. I'm talking about, like, they stimulated the public, but the public still came out with innovation to adapt to the market to where it was at. So you're saying that if they would have let the airline tanks,
not the airline, I'm saying everything. Like I said, like the massive amount of, because the airlines only got 50 billion of the 4 trillion that got put in, or something like that. I think you guys got 2 rounds of it.
It's about 50 or 53 billion.
Yeah,
Somewhere in
but
there.
they're a very small percentage of the trillions that was pumped in. So that's what I'm saying. Like, the airlines might not have like been all right, but I'm saying like the bailout piece of like pumping money into the market, liquefying the market, keeping sure capital is moving across the industry. Like, if they didn't do that, provide some kind of stimulus, and the financial system would have locked up, like society would have just like completely fell apart.
You're saying that we are better off right now because of what they did, right?
Yeah.
So because of what they did, our money supply has grown by 40% since 2020, and 40% growth in 2 years is an insane amount of growth in the money supply, right? So it's caused crazy inflation, which is causing more problem. Which first it was going to be transitory, which we said months ago in this show that we're like, this is not transitory. With the amount of money you're pumping in, this shit is going to last.
We should seriously go work for the Fed and all this stuff, because they all got a wrong role. Like, doubtful. Like, hire me. I can do a better job than you do.
Exactly. So it's like, so you look at all this, and right now the Fed is kind of stressed the hell out on how to control inflation. They don't want to bring inflation down, because their goal has always been to have inflation. Their goal was always 2% inflation. You need to have inflation. You need to have constant growth in the money supply, because if not, like, the whole system just crumbles.
Well, you have deflationary pressures because like as society grows, as new businesses grow, like that's a part. Like you need new money to sustain the growth of new businesses, new population. Because
Right.
it's saying like if money stays, everyone says like, oh, it should peg to the dollar and not move. It's like, well, then prices are going to continue to fall. Then how do you price that into loans? How do you like credit is what does grow an economy. Like we have
Exactly.
been doing that for generations. I
Yeah.
mean, even back, I mean, you can go back in time hundreds of years and they were trying to create credit systems to grow. Or if you have a money supply that's fixed, it's very hard to grow stuff because it's like there's only a limited amount of dollars. And if you have population growing at 2, 3, 4% and money not doing that, that means there's fixed amount of dollars and more people trying to use it. So
Right.
it's going to push things down.
So my point is like now you see all this inflation, we see everything. Now the Fed is trying to come in and they started tapering. They say they're going to be done by March maybe, and they're going to start interest rate hikes to control this. Almost everything that we're seeing is it's going to go from one extreme to another extreme. And one thing they can't have is deflation. Like they can have, what do they call it? Stagflation, where you're having, that kind of in between, like prices are still going up, just not as fast, and you're still having that inflation. But they're saying like there's almost no chance that the Fed is going to be able to control this without a massive like
It's going to be
crash.
very interesting of how that's going to play out. And that was like the next topic I want to roll into today was just like this inflation talk. 'Cause there's a lot of talk about this kind
Yeah.
of stuff. Or it's like the definition of stagflation is you have rising prices and rising unemployment. To where it's like, how do you fix unemployment? Lower interest rates, so business is higher. But lowering interest rates and creating money increases inflation. So like, well, crap, which one do we do? And that's kind of what happened in the late like 70s and 80s, where they just said, screw it, we're going to raise interest rates, we're going to kill this inflation thing. We know it's going to hurt and it's going to create a recession, but we have to do it to stop this inflation because they kind of look at it for the pandemic. It's like, do we let everything fall apart or do we put money in? Like, which is the worst of two evils? Neither option's good. They don't want to do either one, but they have to do something. They can't just sit there and just wait. Otherwise, that could just potentially be even worse.
Yeah.
So I was like, what is going to happen?
So I mean kind of because Tommy has been asking, like, all right, these are all the problems, but what do you do? Like, how do you take advantage of it? How do you monetize on all this? And one of the speculations is what's going to happen to real estate when interest rates rise.
So I found a great article, and it was by what was the source? Oh, can't remember which was the source. So I'd have to open it up. But they talk about that with real estate, like what's going to happen. So it's a very different. They do a great job. We'll link the article in the bottom because like if you read the whole thing, there's a lot in there because they go over multiple asset classes.
Yeah.
It's like real estate. Yes, while people try to compare it to stocks, crypto, all this other stuff, but it's different. People need a place to live. They don't need another share of Tesla.
Yeah.
So it's kind of one of those things. That's why you see the stock market. I think it's down like 10, 15% in the last like 2 months, but real estate values are still up. So going to the article a little bit, it says, interest rates remain low by historical standards, but they're finally moving up a bit. The 10-year treasury was yielding around 1.2 as recently as August. It's now more than 1.8. It's now expected the Fed will raise short-term interest rates 4 times this year, going from 0 to 1% in a world with 7% inflation. Certainly doesn't seem like the end of the world, but the Fed has a psychological stronghold on the markets in many ways. In fact, we're already seeing this with mortgage rates. The 30-year fixed-rate mortgage was roughly 2.8% in August, and it's now up to 3.5%. Again, still low by historical standards, but if these rates continue to rise, that could put some pressure on home buyers. The last Fed rate hike cycle from 2015 to 2018 did see mortgage rates rise, going from 3.6 in early 2015 all the way up to 5% by November 8, 2018. On a mortgage, on a $350,000 mortgage, that's additional almost $285 per month with that kind of interest rate jump. Unfortunately, all else is rarely equal, and the housing market doesn't care about financial theory as much. From 2015 to 2018, you had an interest rates rise from 3.6 to 5%, but housing prices rose 23% over those 3 years. So you still had rising interest rates and you still had rising home prices. So that whole rising, these interest rates are going to tank the housing market. Well, they haven't historically, and they actually go over, like he could not find a single period of time during interest rate rise or hikes over the past like 100 years where home prices fell. And when they were raising prices, they were all still positive. Some of them up to 30%, all the way down to 2% rises over the periods of time, which I thought was actually just, that's pretty interesting. Like I always, same correlation, like, hey, rising interest rates could potentially, it is going to make home buying harder to do. But that was the point where I was saying is like people still need a place to live. They see it as an emotional thing of like, I want to settle down. I want to expand my family. I'm growing. I need a house or bigger space. That's where I say like, you don't need another Bitcoin. You don't need another a stock of Tesla, Apple, whatever it may be, or more ETF or anything like that. So there was a survey done earlier that month by Redfin. And what would they do if interest rates were to rise? And nearly half of the surveyors claimed they would have caused a greater sense of urgency to get in and buy a house now. Thinking like, hey, if interest rates are going to rise, I want to get in and buy now, adding more fuel to the fire to people wanting to buy. And that's what something I thought was even crazier is like, I always kind of wondered that too. Because like, I feel that's one reason why right now for the labor shortages we see in like the construction industry, like where do they all go? It's like everyone is busy as hell. And I think it's a lot of people seeing prices increase and where these old models, there's always that saying like, hey, that past does, what is it? History doesn't repeat itself, but it always rhymes.
Yeah.
That's something like that.
Yep.
Where they say like, hey, rising interest rates cause people to save more because things are going to get more expensive. Well, I don't think that's that way right now. Everyone's like, no, I want to spend now because prices are going to rise. I want to get these renovations done now because prices are going to rise. I want to get that fence replaced because I've needed to do it before prices rise even further. So I think that's another reason why like we just see it's like everybody's like busy as hell. You go into Home Depot or Lowe's, like I've never been to a place where like a Home Depot when like at 10 o'clock in the morning, there's a traffic jam in the damn parking lot because like there's just so many trucks and so many people in there buying. It's like, my God, like everybody is here buying.
And don't go in a weekend.
Yeah, no,
they're a
oh
nightmare.
no. And then like they know now too, it's like there's supply chain issues. It's not just rising prices
No.
they had with inflation in the past, because usually you still had the products were all there, they were just increasing. Now it's the prices are increasing and you can't get the material. Like I was trying to find a tube of one small tube of liquid nail. 3 Home Depots, not a single one had a tube of liquid nail. And like one place had Gorilla Glue's equivalent and there was one tube. And then like you go in, like the paint section is diminished, the caulking section is diminished, and it's like, oh my God, like where's everything going? And so I think that's adding to this fuel of like people wanting to buy, so that to their point where it's just like people are getting this time around more sense of urgency to get those things done now than waiting. So, and then one thing they kind of ended it with is like people buy a house because they want to settle down. They buy because of the stage of life they're in. They buy because of jobs or family or community or schools or locations and dozens of other reasons that come into play before borrowing rates enter the question. So their case in that article was like rising interest rates still don't mean that home prices are going to crash. They're going to stop. It's like they still rise, and especially right now when we're at such historical lows of inventory. So like you're going to still have that constant pressure to where like, yeah, they might not be rising 20% year over year, because I think we can all agree on that. Like that's unsustainable. But there's still going to be positive pressure to people to get in there and buy.
So here's how I look at it, right? The government has come out and said it, and the Fed has said it. They're not going to let housing crash. They can't. Housing crashes, like everything goes to shit for them. You know, everything is placed on housing, like affordability. Everything is, their focus is people need to be able to buy a home. You know, so right now you're getting ready to do the market update for San Antonio. How many months of inventory do we have?
I think we're still like at like 1.7.
1.7.
Yeah.
So
it's below 2. I can't remember
right.
the exact number, but it's below 2.
So even if they raise interest rates and the market slows down, like we're still going to be at 2.5, maybe 3 months of inventory. It's still a hot market. Like it's still, you know, your balanced market is 6 months. You're still at a hot market, and you have the government pretty much backing you. If they raise interest rates right now, and right now that's what we're seeing. I mean, the Dow Jones, I think, is down like total 10% so far.
Yeah.
And usually it's sell in May, go away kind of thing. And we're March and it's already down 10%. So I don't know, you know, they're already anticipating those interest rate hikes. They're not liking it. They're not going to be happy with those interest rate hikes. And if it affects borrowers and people buying real estate, and real estate all of a sudden just like really takes a correction, they're going to have to come back in and lower interest rates right away because they can't
Yeah.
afford to.
Well, and that was like the presentation we watched with that economist. And
Mark Dotzer
yeah, and he said like
is good.
he's like our balanced market where inventory or prices are supposed to rise, like even at 6.5 months of inventory, prices still rise at an average about a 2 to 3%. It's like that's where it really is, like the equilibrium really is. It's like look where we're at. We're below 2 nationally, and so we have especially here in Texas. He's like we have a massive amount of people. Like I think it was I don't know if you heard this, but for the second year in a row, U-Haul kinged the #1 salesman for U-Haul as the governor of California. So the West Coast literally ran out of U-Haul trucks. They couldn't get it. They're just like they were having to figure out how do we get all of these damn trucks from the South and Midwest back to the West Coast for this massive demand of people trying to come to the east.
They need to create like an Uber of U-Haul and just have people that need side gigs just driving.
I'm just
U-Hauls
waiting
back.
to see the day when I'm driving down the road and I just see a train just loaded up with like just U-Haul trucks, all of them heading west. Just like how do we get all these things back over here?
And what's funny is like people say, oh, the big migration, the big move has stopped. More people are not going to be leaving. What do you think that means? When there's no U-Hauls on the West Coast, it's like that's people leaving.
Well,
that's what that means.
Because like Texas, I think they were the #1 gainer of population in like 2020 and 2021 or something like that. Like Texas and Florida gained, like I think Florida was second, like 250,000. Texas in first by a huge margin, like 350. And it's like that pressure on housing is going to be here because like we've seen it with all our rental properties. Like I put something on the market, I'm like, I'm just gonna you know what? I'm gonna go for $200 over what I think the comps would be and see what happens. Boom, first weekend gone. It's like, oh my God. Like there's such high demand for housing that it's like I don't want to be like greedy in a sense, but it's also like it's that equilibrium thing. It's like I put it on the market when I see I'm getting just massive amounts of calls, like, my God, did I underprice this? Like I'm just like blown away of what like this housing cost is for a property like this. But it is what it is.
So Andrew, you invest in a few different cities and everything. Like, how do you see all this?
Well, and because I think that such interest rates are at such historical lows, like you alluded to, that these, if they raise interest rates a couple of times this year, it's largely symbolic. Let's face it. It's what that's going to do to consumer sentiment is the big question. But I think that unless there's a big demand shock, which raising interest rates at 0.5% or 0.75% is not going to provide that shock that is needed to really shake up this sub 2 months of inventory nationwide. So we're looking at it from our investing perspective as values are going to keep going up. Interest rates will also go up, but they're still going to be very, very affordable.
Well, I mean, somebody just commented here saying, considering the influx of people coming to Texas, do you think the rate increases will really affect the San Antonio market, though? Do you think it will drop the prices? You're like, no, not at all. Nope. As like, I don't think, it will slow it down. And I think it does need to slow down. Like you can't like that's
does
what I'm worried.
Though?
Like hey, like I'm it's always fun to watch that equity just continue to go up.
Look at Austin. They were doing this way before the pandemic happened, and dude, it's nowhere near slowing down.
They're not 40% anymore.
Okay,
they're like 40% like 3 months in a row, year over year. I was like, oh my God. But it does need to slow down because that's what happens like 2008 when things get too high and too speculative and it creates political turmoil. And when people like really start complaining that, hey, and that's what I think all of our big fears are is when government tries to step in because they always go way too far. And for our industry of them saying, hey, they could pass a law that you have to own instead of 90 days, like you literally can't sell this to get any type of loan product unless you've owned it for at least a year. I was like, that's the kind of stuff that I would be worried about.
We're already started and seeing a lot of cities and states regulation that we talked about last Friday on wholesaling and everything. So they're ready, and they've been talking about going after investors for a while. Because I mean, a lot of single family homes that have sold over the past couple of years, the majority were to investors. They're buying up a lot of houses, and they're starting to build neighborhoods for rentals. You know, they're not even building neighborhoods to sell houses. They're building neighborhoods for rentals specifically. So we're seeing and the investor demand and everything for real estate is through the roof, and investors are loaded because of all the printing of the money, everything, all the prices going up. But kind of going back to this guy's question, I'm assuming a guy, sorry, Jax, is would rising interest rates affect San Antonio? You got to think about affordability. If rates rise, right, loans are going to be a little bit harder for people to get. They're going to be more expensive for people to afford. San Antonio, compared to the West Coast, it's extremely affordable. So even if it's harder for you to get those, those good rates and everything like that, your money still is going to go a lot further in a city like San Antonio than it will in like Austin or even in the West Coast. So I think if interest rates go up, San Antonio is going to continue
Well, that's
to grow.
like San Antonio is actually one of the top 5 ranked, like by several big studies and stuff, of being like one of the top 5 markets for 2021 because
2022.
yeah, that's what I said.
Okay. Just check.
God, that's what I say. Every time I think about the year, I'm like, I'm still like back in like the end of 2020. Like it's like this last 2 years is poof gone. Now I just completely lost my train of thought.
Well, I guess from our perspective, where we live up in Colorado in the Denver suburbs, prices have gotten so astronomically high,
That's where I was
much
going.
like reflecting the West Coast, that people aren't they're not buying rental properties to put them on the market to rent them out, because you're going to get, a 0.5% of rent of what that home is worth every single month. And
What's making it so hot up there where you are in Colorado?
Well,
Besides the free weed, legal weed.
it's a desirable place to live. There's a high quality of life up there. There's high paying jobs. There's people that are fleeing high income areas to go and high wage earning areas. I'm sorry, where places like California, New York, people want to get out of the city. Like when we had our Airbnbs up there, we had a lot of people that came that were remote workers that just had money to spend but didn't want to spend it where they were, so they came to Colorado. And I think that's driving up a lot of prices. A lot of people are buying second homes and spending a lot of time up there.
Well, that's what I think where I was going with that one is like why they say San Antonio is going to be good is because these other markets flew up so fast, so quickly, and became like so unaffordable that it's like, okay, now we're starting to move into these secondary, more tertiary markets of like the San Antonios or like the suburbs outside of major areas, because the housing prices why they went up 20%, they didn't go up 40%. And now it's like, okay, I want a house, I'm going to go here. And when businesses look to relocate, they look at those kind of things. So like, okay, yeah, Austin's a great place, but like our workforce for what we pay can't afford to live there. And there's going to be a terrible quality of life. So like, let's look at other places like San Antonio. Let's look at other markets that aren't the big names of the South, like your Atlantas or your Dallases, your Austins, or these other places. I mean, Florida's got several of them as well.
So in talking in strategies, right, as far as investment strategies and stuff like that, Tommy brings up doing a lot of owner finance and wraps and stuff like that. I've always been against owner finance purely for the fact that if you are selling a home with owner financing, you are locking in any future appreciation. You're not going to receive any of that, right? You're locking in the price and the appreciation that the property is still going to appreciate. But if you did it correctly and you weren't trying to screw over the buyer, then that buyer is going to be able to refinance that home in no time, and you lost all that potential appreciation. So that's been my struggle with owner finance. It's not that I don't like the strategy. I just think it's a better use of a strategy for when you have a market that's more stagnant, or maybe it's starting to tank a little bit and stuff like that. It's like, yeah, you're not.
Or houses that don't qualify for traditional lending standards. Old electrical. Old foundations got an issue, like where it's like
you're owner financing a piece of shit to somebody.
Not necessarily. It's like you have like a lot of housing stock where the we've always talked about, like the housing value used in order for you to buy that property, renovate it to the current standards, to get a loan and to sell to the retail market, you can't get it low enough.
Right.
prices
They
just
got to
don't-
pay you to buy the house.
Exactly. It's like I just like this house with cost today is like it's gonna take me $100,000 to bring this thing up to traditional standards. It's only worth 120, 130.
Oh,
It's like,
wait. He could. All right. He said no. We are buying them owner finance. Oh,
well,
okay.
that's I was like, he didn't
100% agree,
know, like I
yes.
know
Yeah.
Tommy. Tommy wouldn't be going for owner
Well,
finance
I'm
right now.
just kind of.
But he said like because
yeah.
he made a comment earlier of like here in the next, it was like in a few years we will walk to a home and say, tell me about the underlying note before we even look at the interior of the home. And we've mentioned this several years. Like it's the mortgage that's going to become the asset, especially in high price areas where it's like, hey, what is your payment? What is the interest rate? And what can we do to work out that? Because I want to assume that note, not just the house.
Well, especially if you start getting,
Divide off.
not if, we're going to keep having inflation. Inflation's not going away. Remember that the Fed's target is 2%. That's constant inflation. So what does this mean is that if you have a 30-year fixed mortgage and your payment's $1,000 a month, over the years, that $1,000, you're actually paying it down with cheaper dollars.
Yep.
You understand? Because now with inflation and everything, that $1,000 doesn't go that far.
Well,
But for
especially
you,
the
it's
older-
paying down a mortgage.
And when people understand like mortgage too, it's like I don't want to assume the 29 years left on that mortgage. Like if you got 20 years left on that mortgage, I was like now like I might not cash flow a lot, but like a lot of my principal is going to pay off. I think it was like Dan Francis told us like in the first 10 years of a mortgage you pay off. I think it's like almost 2/3 or over 2/3 of the interest or over half the interest in the first 10 years. Whereas it's like I'm gaining a lot of equity pay down in that house.
So,
but it's one of the things you got to make sure it's like you can sustain the house as well, because like, while the payment might be high, the rents aren't as high and you're only getting like $100, $200 on it. And like, that's not enough to sustain a property long-term, but I'm gaining massive amounts of equity into the property, but you need to be able to understand those things.
So while ideally you would want to get a property that has a loan that's 10 plus years old, so you're paying down principal, really any loan at this point with a low interest rate is still a good loan to absorb. The problem that I see is you got to be able to find the seller that needs to do that deal, right? Because right now, even the lowest price properties that we've seen, you put them on the MLS and they sell with no problem. So it's like and they can get the loan out of their name, everything, and sell for what they owe. You understand? So I think that the target of trying to buy subject to or owner finance from a seller, like it's going to be, you don't have that availability like we used to have, 7 years ago when we were buying foreclosures and doing them subject to. At this point, like they're not hurting. Like they're not, unless they're maybe getting close to being underwater or they owe what the house is worth or something along those lines. But with the appreciation we've been having, I mean, how do you see that playing out with owner finance? Do you guys see like it's a...
Well, I think it's one of those, like we've experienced it of like if somebody sells owner finance, like you got to understand like why somebody's doing that and like how that strategy works. Cause like you're tying up their name, their mortgage is on that thing. And like, and they want to go buy a house in the future in the next 2 years and you save them their credit. Like they don't care. They can cause a lot of havoc to get that loan called due and really mess with you as far as assuming that note. Where I think it does become beneficial. It's like we have some of these, we owner financed from an elderly couple that had multiple rental properties, still had the mortgages, and they wanted to create cash flow for themselves. We're like, yeah, I'll owner finance it to you. And it's owned free and clear or mortgage balance low or whatever it may be. I see it becoming a benefit for that aspect for somebody being like, I don't want to mess with these anymore. I'm at the end of my career, but I don't want to sell them and have a ton of cash. It's like, I'll owner finance them to you. You just make payments over time.
Yeah. And I mean, any thoughts on owner finance?
Yeah, there's always going to be people in a situation that want to use these as like a bond or an annuity type, just income producing. I don't want any hassles. I just want money showing up on the first of the month. And that's that. I think there's always gonna be buyers out there.
And kind of like a book that we've been reading, Think Again. I strongly recommend that book. But the point to this is not telling you don't do owner finance. It's just seeing like which areas you're not going to find them in, so you can start thinking about where can you find them, where can you make them make sense. And like Tommy over here, he's putting like probates, rural, non-sophisticated sellers. Like there are still markets in areas and submarkets that owner finance is a smart way to go.
For sure.
So you need to learn the strategy. You need to understand it. And just because it doesn't fit for the masses, it doesn't mean that it doesn't fit for everybody. And the few that it does fit for, it's going to be a hell of an investment that you get. Because, I mean, you're absorbing now a loan that's probably 10 years old, low interest. I mean, shit. Like, who doesn't want to do that?
Oh, I agree. So I mean, like, yeah, the owner finance is still. It's just you just have to pick the area that it works in.
Right.
It's like I wouldn't be trying to owner finance a house that's worth $250,000 that was built in 1995. It's like I feel like those still got a lot of room to run to increase, and then it's also trying to get a good return on that. Or like the payment would be so ungodly high to get a decent return for that cash because you like owner finance still has a higher interest rate.
Mhm.
You're usually doing like 10% interest or something, 12% interest. When you do a 12% loan on a $350,000 or $250,000 house, like even with a large down payment, like that payment is going to be astronomical to where they're going to be very, very heavily incentivized to get out of that to refinance into something else. And then your cash is back in your pocket. Like owner finance is meant for like, no, I want to owner finances for multiple years to really get that interest payment up because like it's all front end interest loaded before you start getting your principal back. So if they paid off in a year, it's like, well, now I got to go do it again. So I think it's definitely a lower priced asset or strategy.
So how are you seeing now the potential interest rate hikes, everything like this current economy and the potential that we see for 2022? Like, what are your thoughts? Like, what do you guys think is going to be coming down the line in 2022 for as far as the market goes and how that's going to affect real estate?
How it's going to, when you say the market, you're talking the
Everything.
real estate
Like, what do you think
market
2022 is going to do?
or economy or everything?
All of it.
Well, I mean, I think it's one of the stock market is going to be the piece you can already see as they're talking about it. Like and we've had some just, what was it? It's gone up like over 20% the last like 2 years in a row, like in the middle of a pandemic and stuff like, and that's a direct correlation of just massive stimulus and money being pumped into the market trying to find a return. So I think you're going to see the stock market piece is going to be, if you're just like broad based talking indices, ETFs, like they're going to struggle some. For sure. I mean, I don't know if it's going to be like a 50% crash or anything like that. Because one, I don't think that the Fed would let that happen. Like they'll let it go drop, for sure. And then they know it needs to drop, but I don't think it's going to be just like a massive crash for it. Real estate, I think it's still going to be, I mean, just all the headwinds it's got, ultra low inventory, people wanting to move, especially here, higher interest rate, that article I just read of people still needing a place to live.
Right.
It's an emotional purchase, not so much I just want this because I want it. It's I know a lot of people need it. So I think that's going to be where that goes. The one piece I'm very curious of what's going to happen. I'm curious to hear your guys' opinions on these material prices, consumer products, like hiring, like this labor shortage that we got. Is higher interest rates going to help out those scenarios of products, supply chains, and labor shortages?
Thoughts?
You know, stepping back, I just don't.
It's hypotheticals. It's just like, just based on your prior knowledge, higher interest rates, do you think that's going to help the overall job market as far as from the massive labor shortages we got and the supply chain issues?
John?
All right, I'll buy you some time. So let me give you some stats I was seeing recently. So we have right now, and these are approximate numbers because they're always correcting, but we have approximately 10.8 million job openings with 6.3 million unemployed. So we have more job openings than we have people to work those jobs. So how do you think that's going to affect supply chains? How do you think that's going to affect pricing when people can't hire the staff so they can produce the products, or they can ship it, or they can deliver it, or they can sell the product? They don't have the people working there.
Well, this is my theory on is that I think it's going to help it because the economy is trying to expand at a very rapid rate, and there's lots of cash and cheap money.
Mhm.
This is why they talk about like they don't want inflation to get too hot and the economy overheat, because you have these scenarios where like everybody's trying to hire, everybody's trying to expand at one time, the business is good. And when do banks lend to you? When your business is good. And so now you got a lot more money, too much credit being created, and they can't get the people. So like, hey, I'm going to expand this division, and it's going to cost X hundred millions dollars, whatever you're going to do. And then they go borrow it and they try to expand, but then they realize I can't find the people because the supply chain's getting hit because they can't find the people to work and they're trying to expand their business. Everybody's trying to expand at one time and there's just not the people to do it.
Yeah, but what about the problem that I look at more is the mom and pop shops, right? So you're looking at right now the unemployment problem that we're having or the underemployment problem that people are not looking for jobs. They're not even trying to get jobs. It's hard to hire. But then you have somebody like Amazon that's like, we'll pay for your school. We'll pay for your college. We'll pay for your degree. We'll pay for this. We'll raise your wage. We'll pay for your health insurance. They can afford to do all that.
Yeah.
But the mom and pop shops that still need people to run their stores, they can't offer those incentives.
Yeah.
So the way I look at it is like, I always find it funny when they say, oh, tax the rich are greedy and all this. It's like, all of these policies that have been put in place, and it's not even on Biden, or it's been coming. You know what I mean? Trump started a lot of them. Biden's continuing them. All of these policies are making the rich even richer. They're making these massive companies even bigger. And the mom and pop shops are the ones that are really struggling.
Well, that's my point.
adapt.
Is like those people have those assets, and when lending prices increase, and their borrowing rates increase and their economies, their businesses can't expand. That's where my case is like they're trying to slow it down. So those businesses can't do stuff like that to where like when you increase those interest rates, that you'll see that opening job numbers start to fall. And it's not because of hiring. They're just saying like, okay, well, we can't afford to expand like this anymore. The economy is slowing down, not saying going to recession, but it's like, it's not expanding. We can't make this happen. So we're going to close these job opportunities. Because right now they call it like 2020. They're already in 2021. They're calling it the year of the Great Resignation, where people were jumping from job to job to job to job, trying to find these better stuff. And when those interest rates increase, the economy stops expanding. That's going to slow that rate of hiring down to where you then now the mom and pop shop that runs a local delivery business. And it's like, well, I can't go work for these ones because those ultra high rate jobs aren't there anymore because the Amazon's not expanding as quickly or investing as heavily. But now I can go find this job over here being
but they
a
got to
local delivery
survive
job.
until
They
then.
got well, yeah. But then you have these jobs that will start getting filled, and that's where I think it'll help the supply chain. Once they stop putting these regulations and shutdowns and stuff, I think that's another thing. Those need to go away, and then the amount of jobs and money flowing to the economy needs to regress to where people have to go find these jobs. They have to fill these ones that are still going to be open because, like the supply chain issues, it's moving product. It's your entry level jobs that aren't being filled that are the issue because they can't pay $35 an hour and stuff like that. And I think that's why they're trying to stop it, because if they have to increase their business by increasing those wages, that passes down straight to the end consumer, which creates more inflation. So trying to slow down the recovery and the creation of money slows down the rate of expansion and lets people fill in the gaps in between that have been left in the wake of like everything expanding so quickly and moving around.
Go ahead.
And it's a more calibrated expansion. It's slow and more steady and more predictable. And maybe those employees that were on the very edge of maybe quitting their job to go start their own business, maybe with not more difficult lending standards, but also increased interest rates, that might produce just enough hesitation for people to not go out and start their own business. So they will remain an employee somewhere else for a mom and pop that needs the help.
Yeah. I guess I see it more pessimistic towards the view of
Finally, he admits that he's a pessimist.
middle to lower income classes, because the inflation right now is hurting them, right? Inflation right now that's who it hurts the most, because that's where they're raising most of their prices, right? Used car sales have gone through the roof. Groceries, the other day you said you wanted to buy adult diapers and something else, and then it was like $50.
Baby formula.
Yeah.
Depends.
And you spent like $50 on like 2 bags of groceries.
No, it was 300. Well, yeah, and then I went and just bought like $350 worth of stuff, and it was like had like 8 grocery bags in the bed of my truck. I was like, oh my god!
If you spend $300, you can walk out with the bags in your hands.
Yeah, that was it. Like when I walked into the house, like yes, I try to take as many trips as possible, but that $350, it was in one trip. I was able to grab everything and walk in the door. It's like, man, 10 years ago, like I probably would have filled my bed full of a truck bed full of
So
stuff.
going back to my point is that you're having that right now, right? You're having the small businesses that don't have the capital that these massive companies do to incentivize the hiring, incentivize all these things. they got to outlast. Then if interest rates go up, they wouldn't qualify for loans now. They're definitely not going to qualify for loans then. And who's still in power? The big companies are still sitting pretty, not the smaller guys. The smaller guys are still going to be hurting. You understand? So I think like the way this is shaping out, like the lower and middle class are the ones that are going to get screwed the most. And my point is that I don't think the government is going to allow that to happen. So I can definitely see more stimulus checks, more benefits, more bonuses being given out to make sure you keep that lower income and middle class happy.
And those with assets over the last year and a half have not fared poorly
No.
due to runaway inflation. And those who are paying for those products that business owners and asset owners produce are the ones feeling the burden, therefore driving a greater wealth gap. And as you say, the government's just not going to let that happen in today's political climate. It's
Well, they can't because that's the voter base, and they will cater to what that massive base is. I mean, they're the ones that, I mean, there's the population is there. They by far outweigh anybody with massive amounts of assets, and like those are the people that need votes. They need people to go vote for them. So like, what do those people want? They're going to give them. But I think another thing with these rising interest rates definitely help. That definitely help is the fact of you won't have as many merger acquisitions trying to streamline to pick up people and to like eliminate business and competition. 'Cause that's the problem with like when the small business sector can't fill in the gaps.
Yeah.
The big companies will be like, you know what, screw it. Then we can't find small businesses to fill in these gaps. We're just going to go create it ourselves.
Yeah.
And we're going to bring these people in and go do it. So
Yeah, I do agree that you're going to have innovation is going to be what always pulls everybody out. I just want to say, like, I hope it's not, and I already know the answer, but like, I hope it's not more of government intervention versus innovation. And I believe that it's going to happen that way. I think it's going to be more government intervention that's going to prevent those things from happening versus allowing innovation to solve that problem. So I think as far as entrepreneurship and all that, I don't know. I'm curious to see how that's going to all play out.
yeah, no, it is going to be very interesting. I mean, with the rising rates, it's going to be a very interesting climate to see what exactly happens and what comes of it. So it's very interesting. I don't know what's going to happen. I mean, we
Yeah.
can all speculate on it. It's like, I'm still glad I'm in real estate. I'll tell you that for sure. But
What's the next topic you got?
I mean, this is where I was just wanted to spend a lot of time. I was talking like
Yeah.
the speculation of like, what do you think is going to happen as far as like the hiring, the material consumer products, and like, I mean, one thing too is like, where's this political climate going to go? It's like, it's a very tough position to be in that you're in right now. It's like just like how we said, like 2020 was just such a bad timing for a global pandemic to come around and shut the entire economy down because like everybody's trying to get elected, so they will do whatever to get as much done as. That's why I think we pumped so much money into it, and you had so much social duress of just everybody fighting between the social medias, the news articles, the everything. It's like you just don't know what is going to come of it. But now coming into it again, now it's like, well, now we have high inflation. We have the stock market falling. We have stupid high real estate prices. People aren't being able to find. You have a lot of people that are pent up on just getting angry. We have the COVID thing still not being like handled and being like disappearing. So now you have this election's coming around again. So like they're going to use that as fuel to irritate the lower middle class of voter bases to try to gain votes. So it's going to be very interesting of like what this political climate's going to happen. And with today's society of like news is immediate and nobody gives a damn about fact checking anything. It's like, I read the headlines, put it out, because that just gets people the clicks, the digital advertising to my site to click on so we can sell more ads. And like that's going to be, be very difficult for this year.
Tommy here talks about AI and everything, and that's one thing that I'm thinking is with all these places, all these companies and jobs being affected, especially in the lower income brackets, we're going to see a lot more automation, right? We're going to be seeing, I think, a lot more systemizing, being able to use technology, robots, machines to replace more and more people. Like, how do you guys see that playing out over the next year or so?
Yes, I don't know if you guys heard the other day when President Biden had his hot mic incident where he was cussing out one of the reporters.
Yeah.
Right before that, on his hot mic incident, he made a comment, something to the effect of inflation is good. We're going to have more inflation. So what that means, as we're saying, that they need to get it into check because there is driving a greater wealth gap. But at the same point in time, government is incentivized by reducing the value of the dollar, by reducing the debt obligations that it has. And it can't raise interest rates too much because we have such a high debt burden. So I think that this is where free markets and capitalism is going to step in to fill those gaps with artificial intelligence. We're going to contract out to machines and computers.
Well, because that's what, and technology, AI and stuff is a massive deflationary pressure. And that's one thing they're trying to fight towards. Like, we have to have inflation because we have these debt burdens, but now you have technological advancements that are driving prices down. There's like, we can't have that happen. We need to be able to expand the money supply to pay off our debts and stuff like that. So that's going to be a very interesting piece. I think that's one reason why they haven't been able to get inflation like they've wanted since basically 2008. And like, okay, this time around they finally got it by just pumping it just ungodly amounts of money,
40% the money supply.
and then like increasing money supply and decreasing services. Like, that was really the only way they could do it, is like, people are going to stop buying services or change to what they're going to do, and then we increase massive amounts of money supply and create supply chain issues, and there goes the inflation. So it's like they finally got it. So what is going to happen with it? I don't know, but like the AI, I think it is for sure that stuff's not going back. And especially when you see, especially like your service place like McDonald's, we've been talking about that for years, of the automation of like, I'm not paying you 15, 17, 20 bucks an hour to make a hamburger. Like, I can do a machine that makes hamburgers, flips burgers, does it all, doesn't miss a day at work, doesn't call in sick, doesn't have all these like rights around it. And it's like, I can hire a tenth of the staff just to really kind of just monitor the machines to fix things versus flipping the hamburgers, taking the orders.
They're going to come out with a law that you got to have a certain amount of human kappa.
I wouldn't put it past people. Like, if it came down to it, like, I could see them saying like, hey, you can't. I mean, that's what this stuff's designed to do, is to keep people employed, to keep the economy expanding. Like, there's like, free market tries to do it, and if they see it being a detriment to the overall society, they will step in and do some kind of regulation to try to make it go the other way.
To get your guys' feedback on this, like, where I think the solution is, I know a lot of this may sound grim and scary to a lot of people. Like, then what the hell do I do? That's really the question you need to be asking yourself is, all right, what can I do with this coming down the line? You need to learn new skills. You need to get re-educated. And I don't mean go to college. I mean, get re-educated on shit that actually matters. You know what I mean? Get re-educated on things that's actually in demand. And a lot of it doesn't require a college degree. It's simple marketing, social media, a bunch of things that are going on right now. AI, fixing shit.
Like, point right now, even just the trades in general.
Oh yeah.
I mean, just like that. When I say trades, I'm talking about specialized trades, HVAC, plumbing, mechanical, electrical, all of that stuff. Especially in the big commercial space, it's like and the average construction worker is like 60 years old now, and like nobody wants to do that job. Like, what do you think that's going to do over the next 10 years to those prices?
Yeah.
Like, they're going to drastically go up. So like the stuff like that, and like the Votech school is like, that's more of it's education, but it's more of an applied education of like, hey, this for a specific trade. Mechanics, another thing for engines and stuff like that. Like those, I mean, what was it like? Probably, I don't know, 10 years ago. Like, yeah, it was easy to change your oil, or 20 years ago. Yeah, anybody could do it. But nowadays, you look at your oil and you're like, holy shit, I got to take off all this stuff. I got to do all these things. I have all these sensors attached to it. Like, never mind. I'm going to take it to the mechanic shop.
You need a special lug nut to be able to take it off.
You open the hood and it's like, I just see a giant sheet of plastic. I'm like, I know what an alternator looks like, but I can't even see it anymore. Like, it's under all this other stuff compacted.
And a lot of those trades and stuff like that, they don't require 4 years.
No, they're like,
they don't require hundreds of thousands of dollars, right? Like, I mean, it's something you should be looking into.
And if you can get a real world education in something that the market demands, there's huge opportunity right now. If you can teach yourself how to do these skills, either start your business or become a tradesman, tradesperson, whatever that looks like, that there's massive opportunity. And then also getting back to the basics of answering your phone, providing a good, clean workspace, providing a good product. Like there's ample amount
Good
of
customer
opportunity to make a
service.
lot of money.
I don't want to
these
get
days.
stuck in these robo machines. Like, I just need to talk to somebody, please.
Yeah, you end up calling something, and I don't even hear the options. I'm just like 000 representative,
Just hit it
representative.
20 times until it
Like,
finally goes through.
Yeah.
I don't want to hear your options because you're not gonna help me. So, but I mean, even to that point, like, we have a gentleman that's gonna be starting to work with us soon. That he's essentially kind of working for free because he wants to learn the trade. Yes, he's not going to be working for free. We're going to be paying him for the deals and stuff like that, but it's still, he is looking to learn something that can make him money and make him useful as the economy shifts. And like learning how to invest in real estate, learning how to find good properties for investors, learning how to do all those is a great skill to have. If you obviously like the trade, right? If you like real estate, you like all this, it's a great skill to have. It's a great knowledge to have because it's just something that's like people are always going to need a roof over their head. Like they're always going to need a place to live.
Yeah.
So that's not going to be going anywhere. But I think people need to really spend the time to get educated, understand what's coming, and try to prepare yourself as best as possible and stop complaining about the good old days and how screwed up everything is and they need to stop this.
One thing, like societies don't go backwards to
Yeah.
things like that. It's like, yes, do we have regressions? Do we have deregulation? Do we have those things? But like, they don't just go back like, you know what? Social media is a bad idea. Let's just not do it anymore. Not going to go away. Not going to happen. And so there's a lot of those things like, oh, the good old days of this happening. It's like they're not going to start building cars the way they used to build cars. And it's like you have to be able to move with the times and grow with them and adapt and understand what's going to happen. I mean, all the stuff we just talked about, like different strategies of real estate. What do we think is going to happen? It's like why you need to tune into Coffee with the Johns and the Investor's Journey podcast, because we talk about those things of like in real estate. As full-time real estate investment professionals, I'm a licensed broker. Like we're in real estate. We know what's going on. We pay attention to these things. If you're on the outside and just kind of part-time in real estate, like you need to be listening to experts and doing things and educating yourself to stay on top of that stuff.
And it's not an overnight shift. These are just things that you need to change in your day-to-day. Just adapt to the environment as they change. Like your strategy might change. If you buy 5 rental homes this year, your strategy might change on each one of them to adapt to what the new reality is.
Yep.
Yeah.
So
yeah.
it's not like this where you have to regress and come out as a whole new person. Like just change in the day to day as the environment does, and you can keep pace. It's not overwhelming. You just need to stay focused on it.
And going back to the book I mentioned earlier of Think Again, like it's okay to have a plan and then pivot from that plan. Like don't feel that because you said, well, I'm buying 5 homes this year and you bought 2 that you're like, man, I failed because of this, or I got to get 5. It doesn't even matter if they make sense or not. I just got to buy those 5 homes because that was no, stop. And like you're saying, reassess after every single one. Reassess, did this work? Did that work? How can I make it better? Do I really want 5? Maybe I want 2, right? So it's like you got to be willing to just stop and look and analyze what is it that you're doing. And I think that whole chasing the shiny penny and rushing into things without thinking it through is where we're seeing a lot of people freaking out about, these wholesale regulations and everything that's coming down the line. Not sure if you heard about it, but there's this, YouTube guru guy, Jerry Norton, and he's been beating the loudest drum that he wants to start an organization for wholesalers so we can be represented, right? So I'm like, so you're bringing in regulation for wholesalers at this point. So I was like, yeah, that's genius. And you hear people like getting really worried, wholesalers getting, oh my God, these regulations, what are we going to do? It's like, if you educate yourself, this isn't a problem. Like in the places that they've banned wholesaling, you can still wholesale. Nobody can stop you from getting a property under contract because they don't.
That you now have to buy it.
Yeah.
You have to be the owner.
Yeah.
Like the assignment of contract pieces don't exist anymore. It's like my worry is like they do things and pass things like you cannot buy and resell a property within 90 days.
Right.
I mean, I think you'd hit massive regulations and lawsuits if you try to do that against personal property. Like you actually physically own the property.
Yep.
And you saying you can't sell it to somebody. Because I mean, you already have that for FHA stuff. I could see that doing via loan issues, but I don't see they'll be able to buy and resell somebody cash immediately. So that's still quote unquote wholesaling, but you just have to be the owner. I mean, your big wholesale groups, we call them, like, they're not signing contracts. They're
Yeah.
closing it and then reselling it and incurring that transactional cost, because I think they even see that, so they don't care. Like they say, oh, we need to stop these big wholesale. You won't, because they're buying it and they're trying to reselling it cash.
Yeah.
It's like that. That's, they're not wholesaling in the quote unquote like true definition of the standard in my mind. Like a wholesaling is somebody that assigns a contract and doesn't ever take property. They just own an interest in a contract.
Yeah.
I could see that going away, but I don't see you could ever regulate out buying it and turning around and reselling it for higher price to somebody else with the brought cash
Yeah,
to the table.
now you just got to get more resourceful. Finding better private money lenders, finding people that can help you fund these deals for a longer period of time, if it is longer than 90 days. Because one of those things, it's not going to be that this happens and then all of a sudden, you know, there's no more real estate investors ever. No, the market's going to adapt, investors are going to adapt, and there's always going to be a way. There's always going to be a way to make it work. And that's where you got to think about more creatively of like, all right, everything that's happening, all of this stuff, like what's something that's working, and how can I get in there with somebody, go intern for somebody, go work with somebody, even if they're not paying what I need, I'll get a side job, I'll get 2 side jobs just so I can learn the trade, so I'm good a year from now, 2 years from now, and I think that delayed gratification is just a massive problem.
And that forces you to refine your systems, your processes, your thoughts, your business goals. You really have to become a better investor to make that happen. So,
Yeah, I completely agree with that. Who's the author of Think Again? Adam Grant. Yep. Yeah, that book. I mean, we've been reading it, and part of a little book mastermind that we have, and it's just been all of that. Just change your mindset. Like even if you believe this to be true, and somebody else thinks of something else, it's like ask yourself, well, could that be true too? Could I shift my mindset? Could I think about or look at this in a different way that, maybe they're right. Maybe I should do this or do that. So I think just not shutting yourself off to, it's my way or the highway is going to set you up for much greater success.
and Adam Grant's little plug here, but he has a great Instagram page as well that he puts a lot of tidbits of knowledge out. He has different things every day that really force you to sit down and rethink and force some different perspectives. So I'd recommend that.
So one of the things as we start wrapping up that I wanted to ask you is, as somebody that has a full-time job and has had the level of success that you had in real estate, how have you been able to find these real estate opportunities, these deals and everything? Because that's one thing that everybody always complains about and struggles with when they have a full-time job is, how do you find the deals? They don't know how to find the deals. What was it that you did that has given you the opportunity of doing all of these transactions?
Well, as a common theme here, it's not just one thing. It's keeping options open. We've done a couple of things. We've really tried to figure out what we can do by ourselves, what are our strengths and what are our weaknesses, just as a couple that are trying to do it ourselves. So we found strength in finding and being able to purchase good cash flowing short-term rentals, to find the assisted living homes that we did. But also more importantly is we try to find people like yourselves that counter our strengths,
Right.
that we can provide value to them, they can provide value to us, and as a team we're stronger. So we've really focused on building up, keeping and maintaining relationships as well. People that are actively involved to find the good deals, bring them to you, in providing value to the overall. How does that go? The sum of the parts is better than the individual.
Right.
So we're really focused on that as well.
Yeah, and I think that's it's something that we always preach about is your network. You need a powerful and good network. You need to build relationships, nurture those relationships, right? I mean, we wholesaled to you the first house in 2017, right? And we kept that relationship with you. We make sure that we stay friends, we stay working together, doing all that, because look how many deals we've done since because of that relationship, right? And with that, it's been everything else, and the same for you. You've been able to acquire all those deals because of your relationship with us, right? And with other investors and with other realtors and other professionals in the trade that you've developed those relationships.
Yeah, and especially now that we don't live here anymore, and this is a remote location for us, we become more
Right.
dependent on those good quality people that answer their phone, that take pride in their work, that are honest, and taking the time to find those people and build those relationships is wholly important.
And it's tough though. It's very tough
It is.
to
Yeah.
find stuff. And I mean, it's don't go jump both feet in with somebody like hardcore and like bet everything on it. It's like it's the same thing we talk about. Like the patience is something you really gotta build.
And I think if you're starting off and this is your first year, I think what you need to focus on is not making money, is learning. You need to focus on learning as much as possible. Learn everything that you can, absorb as much as you can, because the more you learn, the more better off you're going to be in the years coming. And that was one thing that when I started, that's how I started. I started working for somebody, pretty much like chasing down leads and doing all this. They would pay me like a commission. And I didn't care about the commission. What I cared about was I asked a bunch of questions about everything, every scenario, every single, negotiation, title thing, contracts, everything. I asked so many questions that a year later I was doing it on my own. I didn't need to work with them anymore. You understand? Like, it was something that I was able to learn so much and since then I've been doing this for 6+ years now, and we keep getting bigger every single year because we're always focused on learning versus, I got to make that money. So one of the things that I want to touch on with you, Andrew, is that I admire how you keep saying we, and your wife is a big part of your investing. You guys are in this as a partnership, as a team. How did that come about? Because there's a lot of people I've always seen one or the other. Very rarely do I see the couple agree and be as in depth as we've seen Katrina be with real estate and everything that she's taken interest in.
Yeah, well, much like our external partnerships within our marriage, there's an internal partnership as well. And we each have strengths and weaknesses within the relationship as well. And some people may not agree with this, but if you're married and you're investing in real estate, it is a partnership. Like, you both have to be on board. Not one of you can be both feet in and the other one's afraid or not wanting to do it. So we've kept that paramount. And even though I tend to be the one that implements the day-to-day stuff, we always sit down and we talk strategy, because she's always that person that's, firing off, well, what about this? What about this? Like, that's a terrible idea, Andrew. And, like, I need to hear that, because I would get into these things otherwise that maybe wouldn't be the best of ideas. So I really use that as a sounding board. Yeah, exactly. Just to bounce ideas off of it. And we'll just talk about it over a casual dinner. Like, it's nothing formal.
Right.
Maybe once or twice a year we'll sit down and try to come up with goals or intentions.
Yeah.
But it's just a day-to-day thing and now we've been doing this together. We've had so many of these conversations that they take less time, because we're kind of on the same page. We know what the other will not agree with, but what the pitfalls of each other's ideas are.
And the fact that she's taken an interest in also learning and knowing it, I mean, it helps tremendously as well.
Yeah, certainly.
So yeah, I mean, I admire that. I think that, that's definitely been Katrina's definitely the key to your success.
Agreed.
But I think that's a very good partnership to have, especially because this business, as we know, it's extremely stressful. There's a lot of things going on with it that if you have to go home and you don't have that support at home, that you can just like kind of let go of, let them know all the problems, let them know all this, and they can provide some constructive criticism or feedback on it because they care. Like, I mean, if you can't have that, you end up being so alone in this space.
But it's so beneficial as well. Like, we've decided a long time ago that we were just going to live on one income and save the other for real estate investing. And I couldn't do that by myself. She couldn't do that by herself. But together, like, we're able to live a good life, save money, and invest, and do it wisely.
Very good. Any parting thoughts or words? Anything that you guys wanted to hit?
Hit that like button.
Hit that like button. So I hope everybody enjoyed our first episode of season 3, Coffee with the Johns. We will not be coming back every single Friday morning, but we will be doing it a few times a month. We're just going to see based on the news and our availability. You'll be getting a notification if you join our text community at 210-794-9898. You'll get notified every time that we're getting ready to go live. So, we can bring you the freshest information, strategies, everything that we're doing. But with that being said, Andrew, thank you for joining us.
Yeah, thanks for having me on. It's been a great pleasure.
welcome.
Yeah, it's been a lot of fun. And John, pleasure as always, and we'll catch you guys on the next one.
Bye-bye. Boom, baby, I got 2 likes. We're at 13.